It's time for the Brian Beatty Real Estate Show.
Good morning, Charleston, and welcome to another edition of the Brian Beatty Real Estate Show, your local resource for everything housing and home ownership across the Charleston and Low Country area. I'm your host, Brian Beatty. I've been selling real estate for about 20 years, about 1,500 homes sold in that amount of time, and I appreciate you spending some time with me today. So we're going to dive into something that is a big, controversial idea that's really all over the news right now. And the question is, should the United States introduce a 50-year mortgage? Right? So there's a proposal being floated around in Washington, D.C. right now to allow 50-year home loans through the government-backed mortgage system. You know, think Freddie Mac and Fannie Mae, as part of a plan to, quote-unquote, fix housing affordability. So the White House has talked it up as a way of lowering monthly payments. And obviously, you've got some critics out there that are calling it everything from a Band-Aid to just an outright distraction from the real issue, which is the lack of homes to buy. And so here in Charleston, this hits especially close to home. You know, according to, the most recent data, we basically went from a median sales price in Charleston County of about $240,000 a decade ago to $760,000 today. So depending upon which data set you look at citywide medians, you're looking at $625, $650 for current listings and recent sales. So, I mean, affordability is obviously an issue. So what I want to do is I want to unpack what a 50-year mortgage really looks like, who it helps, who it hurts, whether it's a good idea or not, and kind of break it down into a few different buckets, right? What it means for buyers, how it's going to impact the resale market, and really how it's going to impact, in my opinion at least, the overall housing market. So we're going to talk about that. We're going to talk also about the idea of a portable mortgage, which is not something we currently have, but the idea behind it is you get a mortgage when you buy a house. Some years down the road, you decide to buy a different home. You get to keep the first mortgage that you initially qualified for and bring that with you to the other property. And of course, if the other property is more expensive, then you get an additional mortgage for the additional amount you need financed. And so I want to talk about that and really talk about just some kind of man-made solutions that might impact the housing market. A lot of different ideas are being thrown around right now. So we're going to dig deep into that this segment, this show. But again, if you guys want to reach out to me, we've been doing this show for close to 15 years now. We've got over 1,000 videos on YouTube where I video myself while I'm here in the studio. You can watch along if you miss a portion of the show. We break it down into different segments for you. But ton of content online. Listingsincharleston.com is our website, listingsincharleston.com. And you can always call or text me if you want to have a personal conversation with me privately. My number is 843-800-0065. That's 843-800-0065. Again, listingsincharleston.com, or check out our YouTube videos or podcasts on iTunes, Spotify, Google Play, all that great stuff. So let's kind of go back to basics, right? What is a 50-year mortgage, right? Well, right now, obviously in the U.S., the standard is a 30-year fixed mortgage. That product doesn't really exist, quite frankly, in most of the world like it does here, but in parts of Europe, as an example, like Spain and France, countries like Mexico, lenders already offer a 40 or a 50-year term in small numbers, right? And frankly, even longer if you look at international loans and intergenerational loans that have been in place in places like Japan. So it's not unheard of, but the pitch behind a 50-year mortgage is pretty simple, right? It's stretch the loan out longer and the monthly payment goes down, right? Well, if you're looking at a property that's, I ran this scenario for somebody a little earlier. If you're looking at a house that's like $415,000 with a 10% down payment, if you were to go from a 30-year to a 50-year mortgage, you're basically saving $260, $270 a month. So on one hand, yes, your payment is lower, but here's the catch. And here's where economists are waving their red flags, right? It's you pay a lot more in interest over the life of the loan, and you build equity much more slowly, right? So there have been a bunch of different analysts that have chimed in on this issue. One said that if you pay, on just the average median priced home on the median priced home in the United States, you would pay almost an additional $400,000 in interest over that 50-year term rather than getting a 30-year mortgage, assuming, no price appreciation. So yes, you're lowering the monthly expense, but you're stretching out the financial pain essentially for decades. And then, of course, when you layer in demographics, the median home buyer is about 40 years old right now. So, I mean, really at the end of the day, how would you feel knowing that the mortgage you take out today will almost certainly outlive your working years, maybe even you? So that's the psychological and kind of financial trade-off this whole conversation is really about. So let's talk a little bit about some of the pros and cons. Let's kind of go rapid fire here on what some of these pros and cons are. I mean, obviously, first pro is that you're lowering your monthly payment. For most folks, it's going to be a few $100s a month, more than likely, even more depending upon, the price point you're in, which could do things like get you into the neighborhood that's closer to work, or get you into a better school district, or maybe get you closer to the water or the beach, or maybe just gets you a bigger, better home with nicer features, right? So in the short term, obviously, there are benefits for somebody that could then go and afford a bigger, better home. It's also, of course, easier to qualify on paper because the monthly payment's lower. Your debt to income ratio is going to look better, which means you can afford to borrow more money, right? Which could also, of course, be a con. And then the third way of looking at this, which I've heard a few different perspectives on, is that if you are the type of person that's really disciplined financially, this could work out really well for you, because let's say that you want to buy a home and you already qualify to afford the home you want to buy with a 30-year mortgage. Theoretically, you could get a 50-year mortgage, which lowers your monthly payment, and you could take that difference and apply it toward the principal balance of the loan. Or you could fund retirement accounts or college savings accounts, or invest that money so long as the investment is doing better than the cost of the interest, which for the most part is going to be probably around 7%, right? So the cons here, there are several of them. And really what we're doing today is we're kind of highlighting these issues. I'm going to bring in a lender next week, and we're going to pick this apart piece by piece and talk about some things that maybe you haven't thought of, or maybe some of these folks that are writing these articles haven't thought of, but really give you a clear picture of how this would work. Will it work? Is it going to happen or not, essentially? So some of the cons are, of course, that you become kind of like a permanent payer. In a way, this is almost like the subscription model to buying a house, because your equity builds very slowly over time. Of course, you're also paying massive amounts more in interest over the course of the life of the loan. Now, I understand that most people don't own their home and stay in their home for 30 or 50 years, right? They're going to sell, they're going to refinance. That 50-year mortgage at some point is going to go away. But in the short term, yes, it might look good on paper. It might help you save some money. But in the medium term to long term, I think you're exposed if the market turns, because you've paid so little principal in the early years of the mortgage. If the market dips, it's easier to end up with low or maybe even negative equity, which of course makes things harder to sell, especially if you have to come to closing when selling your house and pay money to sell your house, right? The other con here, of course, is that it doesn't really fix the big, real problem. Almost every serious housing economist keeps coming back to the same issue, which is basically we don't have enough housing supply in many markets across the country, and prices ran way ahead of incomes, which is something we've talked about on this program ad nauseum for years at this point. But starting at around 2020, home prices and the cost of home ownership far outpaced the increase in wages and incomes, right? So lowering payments without adding supply risks, just pushing prices higher. And then, the last part on this is that I think it does create more of a wealth building gap. It widens that wealth gap, particularly in like working class households. There's a large percentage of the population that essentially works paycheck to paycheck. And I think you'd be trapping a lot of those folks in kind of longer term debt with very slow equity growth, which could sometimes be over multiple generations. Because one thing to take into consideration is that Lenders cannot deny somebody based on how old they are, right? Age is one of the protected classes. You could give a 90-year-old a 50-year mortgage. So, if you're listening and you're thinking, well, if they offer it, I'll take the 50-year and just kind of worry about the rest later. I would encourage you to really think through this, especially, of course, if this becomes a reality. And so I'm going to take a break, and when we come back, we're going to talk about what I think this might mean for new construction, what it means for the resale market, and what it's going to do to the market overall if this actually ends up coming to reality. So stick around. This is the Brian Beatty Real Estate Show. Remember, if you want to check out my content online, you can look at our videos on YouTube. Would love it if you'd like and subscribe to those videos so that you can see new content as it's being put out. Check out our website. A lot of great material on there as well. Listingsincharleston.com is our website. That's listingsincharleston.com. And if you want to give me a call or text me and discuss your personal situation, that number goes straight to me. So we'll be the one having the conversation. My number is 843-800-0065. That's 843-800-0065. So we are talking this morning about the impact a 50-year mortgage would have on the real estate market, not just in the market in general, but of course here locally in the Charleston area. So, if you guys want to reach out to me, if you have questions about this, if you're thinking about buying a house and you're looking for some creative ways of approaching the process, let me just tell you that there are plenty of options and programs that already exist that aren't talked about very frequently, whether that's down payment assistance programs or actively reducing the interest rate through incentives provided by sellers and builders. There's a few different ways to approach this. And so if you're thinking of buying a home, selling a home, we'd love the opportunity, of course, to earn your business. We've been in real estate here for 20 years. We've sold about $1 billion worth of real estate in this market. So I'd be working with you personally. Would love the opportunity to chat with you further about that. My number is 843-800-0065. That's 843-800-0065. Or you can check us out online at listingsincharleston.com. That's listingsincharleston.com. So let's go back to this discussion about 50-year mortgages. Let's talk about what this means in the new construction segment of our market, right? Of course, you're going to have more buyers that can qualify for brand new homes if we're stretching out the life of the loan and therefore lowering monthly payments, right? Builders love anything that makes their price point look more affordable on a monthly basis. I mean, if a 50-year mortgage adds a few $100s of buying power per month, it lets some buyers stretch into a new home they wouldn't otherwise have been able to afford if they were getting something like a 30-year mortgage. And I think, of course, it could help to move some of the standing inventory that builders are sitting on, whether it's a completed spec home or lots that they're ready to develop and build on. A longer-term mortgage could be used as a marketing tool in addition to what they're already doing, because a lot of these builders own the mortgage companies and they're artificially lowering the interest rate and therefore the payment associated with buying that house, which is something that has been incredibly challenging to compete with if you own your home and you're trying to sell it on your own, right? What we call a resale. But of course, the risks would mean that builders are just going to push prices higher, right? If you give the market more payment room, history suggests a lot of that room will get absorbed into the price, right? So instead of making homes truly less expensive, cheaper, it might just enable builders to charge more and still, close the sale. But I think the other even more concerning thing is that it creates more leverage in a cyclical industry, right? New construction buyers are often at the edge of their affordability already, right? And that's not just new construction, but that's for a lot of people just how this works. They submit their financials to a lender, they determine how much they can afford, and then they buy a home that represents the maximum amount they can afford. It's just human nature. I've seen it, hundreds and hundreds and hundreds and hundreds of times, 1,500 times. And so, when you put them in a 50-year loan with HOAs, with higher insurance costs, and in our area, rising flood and wind insurance, and you've created a very leveraged group of homeowners that are vulnerable in a downturn. So, I think in simple terms for builders, 50-year mortgage is mostly a demand booster, right? It helps them sell what they're building, but it doesn't do much to encourage more builders to start more affordable projects, which is really what's needed. So then it becomes a question of, well, what happens to the resale market, to the people that already own their home that want to sell it, that are competing against these builders, right? Well, if you look at the Charleston market, median list prices are mid 600s. Days on market is stretching out to, in the 50 to 70 day range, depending upon your area and price point, of course. So then if you inject a 50-year mortgage into that environment, then in the short term, you're likely going to see an increase in demand, right? More people can afford to buy at today's prices. And, some folks that are, sitting on the sidelines might jump in because the monthly payment now finally fits their budget or what they think they should be buying based on how much money they're spending per month, right? It also is going to support current price levels, right? Sellers love anything that makes their home more financeable. So if buyers suddenly have easier payment terms, sellers are going to feel less pressure to cut their price. And we're going to talk about this a little bit later on in the program, because as I know I've mentioned this many a time on this program. My company actually hired a private statistician out of Atlanta to look at our market and provide us with some statistics and view our market through a different scope and with different data than we normally get as just members of our local MLS, right? So we've got some really interesting statistics for you, especially as it relates to properties that reduce their price or maybe start high and then drop their price and what happens to their bottom line. Some really interesting statistics to read off to you a little bit later on in this program, but for now we'll stay on task. I think that, in the longer term, you're going to have low equity sellers. If you buy with a 50-year mortgage and then you try to sell it in 5 to 7 years, which is about, most people are staying in their home. I think that the stat now is 12 years. But let's say you stay in that home for 5 to 7 years, you probably haven't paid down much in principal, just based on the way the allocation of your payment works with regard to it going toward interest or principal. So if the market hasn't gone up significantly, your equity position could be fairly weak, especially if you're doing something like a 3.5% down payment. So that makes move-up purchasing harder, and it increases the risk of having to bring cash to closing just to sell the house. I think it also creates a potential for pricing air pockets, if you will. If the only thing propping up demand is ultra long loans and we're not looking at the fundamentals like income growth and supply, then any change in regulation or interest rates or investor appetite for those long dated loans could have a kind of sudden, almost like cooling effect on prices, which is backed up by research from the Fed and IMF and all these others that are kind of consistently looking at the data. And they find that when you play a lot of games with mortgage rates and terms, it basically amplifies this boom and bust cycle in housing. So, I guess in plain English, a 50-year mortgage might help today's sellers in the short term, but it could make tomorrow's sellers, right, the people buying now, a lot more fragile if the market shifts. So if we take a step back and we kind of look at the big picture here, almost every serious economist looking at this proposal agrees on a few things, right? Number one, we have a real affordability problem, right? Home prices ran way ahead of income starting in 2020. And even with, the recent Fed cuts and some of the pressure that's been alleviated on interest rates, lower interest rates alone cannot erase the damage that has been done by these massive price increases. And when I say damage being done, I'm not necessarily saying that our housing market is broken by any stretch of the imagination, but for a lot of folks, even those that bought their home a few years ago, if they were to go and qualify to buy their same exact house at today's prices, they wouldn't be able to afford it. They wouldn't be able to afford it on paper. So we have a real affordability problem. We also have a supply problem. We haven't built enough new construction homes in the right places across the country and at the right price points for a long time, for about 10 years. And, local issues like zoning and permitting and labor shortages and material costs, it all feeds into that. right? But I think that a 50-year mortgage is mostly a demand side tool, right? It makes it easier to buy on paper. Or if you think about it this way, yes, you're stretching out the life of the loan, but it doesn't create a single new unit of housing, right? Yeah, you might create some more buyers in the short term or maybe even in the long term, but we're not creating more supply. So likely what happens is prices go up a little bit because now sellers understand that they've got a product that allows them to afford a more expensive home by just stretching out the life of the loan, right? So I think that's why a lot of housing experts and frankly local lenders here in Charleston are calling a 50-year mortgage something like lower payments now, but the bank wins in the long run, which is almost the exact opposite of what happened several years ago when we dropped interest rates down to 3%, below 3%. Banks aren't making hardly any money on that. They can't wait to get out of those mortgages and for you to go and buy something else. So, I mean, here's my read on this situation, right? In the short term, if 50-year mortgages are introduced, I think we'd see a pop-up in demand, both for new construction and in the resale market. Some marginal buyers would finally kind of get off the fence and buy a house. It could help builders move more inventory, and it could help some sellers get their asking price. I think in the medium term, if we don't fix the underlying supply constraints, a lot of the benefit gets absorbed into just higher prices. And we're kind of back to where we started. Except now we've got owners with more debt and slower equity growth. In the long term, I think we risk turning home ownership from a wealth building tool into like a kind of permanent subscription payment model, right? Especially for younger and lower income buyers. That's the opposite of what, housing policy should be. So, my personal bias, I guess, would be to keep them very narrowly targeted, right? Maybe to certain lower risk borrowers or to specific like affordable housing programs. And I think if you pair that with like serious supply side reforms like zoning changes and faster permitting and incentives for affordable and workforce housing, or maybe even create some things like a portable mortgage, which we're going to talk about next, that don't trap people in place, that could be a real consideration. So I think if you're looking at this and you're thinking, this is the answer to my situation, my challenge right now, I'd love to get you on the phone with one of my preferred lenders to talk through some of these scenarios and situations and see if there's something that currently exists, or maybe there's an opportunity for us to negotiate with the seller to lower your interest rate, either temporarily or permanently, to get you into the home that you want. There are a lot of different options that exist. So if that's something you'd like to discuss with me, again, my number is 843-800-0065, 843-800-0065, or you can check out our website, listingsincharleston.com. That's listingsincharleston.com. I always like to take a moment and just say that I appreciate those of you that listen to this program. I've heard from several of you so far this year. We've had the pleasure of doing business with a lot of you. And I know a lot of you just listen for the sake of listening and for the educational material and for hopefully a little entertainment along the way as well. So just wanted to say thanks for being a listener to the show. It's great being able to come on here week after week and just kind of tell it like it is, really share my thoughts and opinions on the market without the need to worry about likes and subscriptions and clicks or creating this crazy content that's just designed to get views like what you see so much on YouTube. So I try to be very down to earth, I like to keep it real. And that's what you can expect with me when we work together to help you buy or sell a home, as well as somebody that's just very transparent, very normal and even keel, but extremely experienced. I'm one of the few agents in town that have sold $1 billion worth of real estate over my career. So would love the opportunity to work with you if you're thinking of buying, selling, or investing, or maybe you have a property you'd like for us to manage for you through our property management company. Either way, feel free to give me a call, 843-800-0065. That's 843-800-0065. Or check out our website, listingsincharleston.com. So we just talked about the idea of a 50-year mortgage. And like I mentioned, we're going to have a lender on the show next week to really kind of break this down and help you understand what that might look like. Will it actually work? If it does, there are a few different ways things can go. I think laid out the groundwork for my thoughts and opinions on the matter, but we're going to get a little more detailed, a little more specific next week on that. We're also going to talk more about what I want to talk about right now, which is the idea of a portable mortgage, right? It's another thing that the White House, FHFA, and a lot of economists are suddenly talking about, and that is to make a mortgage portable as a way to kind of jumpstart what seems like a fairly gridlocked, just slow housing market at the moment. So we're going to talk about, what a portable mortgage actually is, how it might work in the real world, the pros and cons, and whether ultimately this helps or hurts the overall housing market, new construction, resales, and everything in between. So, let's just kind of start with what it is. So here's a simple definition, right? So a portable mortgage is a home loan that you can take with you when you move, right? So instead of paying off your old mortgage and then getting a brand new one at whatever today's interest rate is, you transfer your existing mortgage, same interest rate, same basic terms, to the new property. Now, of course, this is different, by the way, than an assumable mortgage, because in an assumable mortgage, the buyer takes over your loan. Portability is you, the homeowner, taking your loan with you and moving it to the next house, right? So like countries like Canada and the UK, they already have some form of this, mortgage portability. They've had it for years. You sell house A, you buy house B, and if you qualify and the lender agrees, you port that mortgage over to the new place instead of just starting from scratch. Obviously, here in the United States, that is not how it works. Most mortgages have a due on sale clause, which means that when you sell the house, your loan must be paid off in full. There is no portability, right? So why is this even on the table right now? It's because of this lock-in effect that we've all kind of been subjected to over the course of the past several years. And a thing, not issue, but a thing that many of us benefit from, right? Not all of us are interested in moving. I was lucky enough to buy a house at 30 years old that for my wife and I will represent our dream home. I'm not sure we can do much better, quite honestly. We were in the right place at the right time with the right situation, and we were able to get lucky and buy a beautiful home that we really have no interest in selling or moving from at any point in time, right? We'd have to win the lottery in order to upgrade and do something really incredible with the home that we would live in. So for now, we're fine. We have no interest in moving. And my guess is that that is a large portion of the population right now, especially those that are in their older years or that are kind of sunsetting at work and getting ready for retirement. Of course, what's going to come into play is, do we keep this big, beautiful home or do we move into something a little more manageable, right? That's what a lot of my clientele is doing right now is basically selling that home that was their forever home and simplifying, downsizing, getting rid of the landscaping, cashing in on this huge amount of equity that have been created over the course of the past decade, right? So it's happening because of the quote unquote mortgage lock-in effect. A lot of Americans refinanced or bought homes at ultra low rates, 2%, 3%, 4% during the pandemic years. And so today, the average rate for a 30-year mortgage is somewhere in like the 6% range, low to mid sixes, give or take. And so if you've got a bunch of people that on average are at like a 4% interest rate, there's a obvious reason why people aren't moving. It's because they cannot stomach or they simply can't afford the increase in payments when going from 3% to 6.5% on a bigger, more expensive home. It's just not in the cards. That's why we have this big affordability issue, right? A recent Newsweek piece explains that portable mortgages are being floated as a way to let homeowners keep their low rate when they move, potentially unlocking some inventory and freeing up mobility. But the FHFA director, Bill Pulte, said the administration is actively evaluating portable mortgages as an alternative to ideas like the 50-year mortgage that have gotten a lot of pushback. So basically, in plain English, we've got millions of people that are either stuck or happily stuck in homes they've outgrown because they don't want to give up a 3% rate for a 6.5% rate. So could a portable mortgage unstick that situation and get rid of that quote unquote lock-in effect? So there's a lot to uncover here, and this is why we're going to bring on the lender into the show. But essentially the way it works is, let's say that in this model, a few things would happen. Number one, you would port your existing loan. So let's say that you keep a $300,000 mortgage at 3% and you transfer it to a new home. And you have to, because the home is, like $550,000, you're going to put $100,000 in equity in it. You have to get a separate mortgage for $150,000. Well, that mortgage of $150,000 is going to be at today's interest rates. So you're going to have to qualify for your existing mortgage at $300,000 at 3% and the $150,000 second mortgage at 6.5% or whatever it is, right? You've got to cover the gap in some way, either with a larger down payment, cash, or a second mortgage, right? Or maybe there's even some sort of blended rate product out there that they come up with. But my guess is that there are going to be fees and restrictions and prepayment penalties and exit fees. And, lenders want to keep a lot of the control over whether you actually port that mortgage or not. I don't see there being a guarantee of approval just because you have a mortgage, right? This is where a lot of the complications come into play, right? I mean, obviously the pros are things like unlocking a quote unquote frozen real estate market right now, especially for people that want to move up, right? It gives more mobility for jobs and for life changes, and it creates a potentially smoother chain of transactions. If you're moving from Charlotte to Charleston or Charleston to Indiana or wherever, right? It could create a bit of a smoother transaction, a healthier kind of ladder, if you will, from a starter home to your next bigger, better home, right? And it might be better for older owners that have low rates because of the amount of appreciation they've seen and the amount of equity they have. And that's the challenge, is a lot of people don't want to view this equity as money that could be used to go toward paying the higher payment for the more expensive home. They want that equity in their home to go toward debt or vacations or retirement accounts or whatever. Very rarely do people actually view the equity they have earned as money that could be set aside to pay the higher payment, right? They want that money to be used for other things. The serious, of course, con and unintended consequence of all of this is that it mainly helps existing homeowners, right, that already have those really low interest rates. Because if we're going to create portable mortgages at today's rates, unless interest rates go crazy, who wants to take a 6.5% interest rate with them to another property? It would make more sense just to sell it, close out the loan, pay it off, and then go get a new loan somewhere else, right? The other thing is that honestly, it could push interest rates even higher. I mean, if you look at the difference between a 15-year mortgage and a 30-year mortgage, a 15-year mortgage is going to be lower than a 30-year. Therefore, a 50-year should be higher than a 30-year. Same thing if the bank that is servicing your loan or the investor that owns that debt now has a much longer duration asset, right? They hold that property for longer. Right now, obviously, the way it works is that you sell your house, you pay that loan off, right? It's just, it's not compatible with our current system without pain. The truth about mortgages is what it's called, argues that true portability is basically impossible in a U.S. system built around long-term fixed rates and due on sale clauses. To retrofit existing loans, you have to deal with investors who bought mortgage-backed securities on the assumption these loans end when the house is sold. So, it obviously opens the door to legal questions and complex compensation to existing investors that own the debt, or to limiting portability to newly originated loans going forward, because the investors are going to have a real tough time if they say, all right, well, look, interest rates are at 3%. We're not making really any money by giving people mortgages right now. which is why I was telling you back in the day when I was on the show and interest rates were super low that you're not going to beat up the seller in this type of market. There are too many people that are trying to buy homes. It's really hard to get a quote unquote deal on a house you buy from the seller by negotiating with them directly. The deal you're going to get is with the bank. And so when those banks sell those mortgages and they get bundled into mortgage-backed securities and sold in sold in the secondary mortgage market, those investors that own that paper are going to have a really tough time with us basically retrofitting them with portability, right? They're going to say, wait a minute, I didn't anticipate having this 3% mortgage that yields me next to nothing for 30 years. I was thinking 5 to 7. So, I mean, it on one hand, it could create some very interesting options for people, especially if they are retrofitted to existing mortgages. My guess is that won't happen. I think it's just too hard. It changes the system too much. And I think it can create some real challenges just in terms of the logistics of getting this to happen. I just don't think there's going to be enough steam to make this happen, but I could be wrong. But again, we're going to talk more about it. And really, at the end of the day, what we're talking about here is like man-made solutions to fix our real estate market, as opposed to just letting it ride, right? Just let it be, right? Economics 101, let it be. So, we'll see what happens with all of this stuff. I think for right now, what I want to do is tell you a little bit more about what's happening in the market right now, give you guys a bit of a read on if you are going to buy or sell right now, what can you expect? Aside from all the stuff that's been happening and the severe distraction and real pain that the government shutdown has caused people over the course of the past 45 days, which has just been a nightmare, absolute dumpster fire. I think that now that people are kind of refocusing on things and you're thinking about buying a home or selling a home or investing in real estate or having one of your investments managed by a property management company, we'd love the opportunity to earn your business. We're running some great incentives right now. If you'd like to learn more about that, feel free to give me a call or text me. My number is 843-800-0065. That's 843-800-0065. Or check us out online. Listingsincharleston.com is our website, listingsincharleston.com. Or you can check out our videos on YouTube. Or, of course, you can just listen to this podcast anytime on iTunes, Spotify, Google Play, iHeartRadio, I think, as well, and WTMA.com. A lot of crazy things happening in the world of real estate right now. It's never a dull moment, right? I appreciate you all listening to this show. We're going to talk more, of course, as the weeks go by on what some of these changes might mean for the market, how the market is evolving, what selling in the winter months looks like, all those things to come as this show continues to go on over the course of the next few weeks and months. But what I want to do right now is just give you guys a few stats that, I mean, you can go and you can Google like the median sales price in our market. Some of this stuff is really easy to find. What I want to do is tell you some things that are not easy to find, because these are statistics that are provided to us through a company that we've hired out of Atlanta. Only our company has this stat. And it provides us and our clients with some really great direction as it relates to things like pricing your property to sell and really understanding the impact that pricing strategy has on your bottom line. And so we break this information out by different price ranges, by different areas. If you want access to this report, it's 35 pages. No one else has access to this. So if you'd like it, just text the word report to 843-800-0065. Text the word report to 843-800-0065, and I'll send you a copy of this. So just a few highlights, right? Number one, we are inching more and more and more toward a balanced market. We have been in a seller's market for over a decade at this point, right? Where really there is less supply and more buyers, which is what has pushed pricing up. Right now, the only market that is a normal market, meaning 6 to 7 months worth supply of inventory, I won't geek out on all the definitions behind the data points in and of itself, but the $2 million plus market's the only one right now that is headed toward a buyer's market. Everything else is creeping toward a balanced market, but is still, by definition, a seller's market. One thing that we have seen this year is that properties are just selling for less than their asking price. In fact, when we break it out by category, by price point, 7 out of 8 price points are performing worse this year than they were this time last year. The only price point that has remained unchanged is the $400,000 to $500,000 price point, which is getting 97.6% of their asking price. On average, across the board, we're getting 97%, right? That's down about 0.5% from this time last year. We're also seeing days on market start to really go up, right? We've increased 32% in that area across all price ranges. I mean, you look at something like the $650,000 to $999,000 price point. Q3 last year, the properties were selling in 12 days. Now they're selling in 36, right? So that's tripled. We also look at things like price reductions. Over 50% of all listings that are selling right now are going through a price reduction, which is up from this time last year. When we look at those price reductions and the impact it has on the sales price, it's really, really interesting. And so let me skip down here really quickly. I can put all these stats on, or slides, if you will, on the video that we put out. But for all the properties that, like, here's the real story. For all the properties that have sold, as it relates to price reductions, 50% took price reductions. If you took a price reduction, you sold for 93% of your asking price in 76 days. If it was previously listed by another agent, it sold in 140 days and for 90% of the asking price. But if you didn't have to do a price reduction, which represents the other half of closings, you got 100% of your asking price and you sold in a week. There it is. I mean, those are the stats in real time. The other challenge here is that almost 3 out of every 10 properties that hit the market right now are being taken off the market. They're being withdrawn. They're expiring from the market. They are not selling. They are failing to sell. So for every 100 properties that hit the market, 27 come off the market because they failed to sell, 73 sell. Of the 73 that sell, about half of them are taking price reductions. They're selling for 93% of their asking price in 76 days. If they didn't have to take a price reduction, they're selling in a week. In fact, a third of those that are selling for at asking price are actually selling above asking price, which basically says that 63% out of every 100 listings in our market right now is overpriced. And there's a lot more that goes into these stats when we look at things like seller paid closing costs and the amount of those concessions and the fact that that's way on the rise. The market's definitely changing. If you want to get access to this report, again, text the word report to 843-800-0065. That's 843-800-0065. You can, of course, call or text me on that number and have a private conversation or check us out online, listingsincharleston.com. But you guys enjoy your weekend. Thanks for listening to the Brian Beatty Real Estate Show right here on the Big Talker 1250 WTMA.
Join us for another edition of the Brian Beatty Real Estate Show next Saturday morning at 9 and Sunday morning at 10. Find him online at listingsincharleston.com. That's listingsincharleston.com. Or call him at 843-800-0065.